Assalamualaikum warahmatullahi taala wabarakatuh, and a very good morning respectively to Madam Putri Nurul Aina. Today our group will be presenting our slide for our group assignment.
Assalamualaikum. For today, I will be presenting my part on the assignment of accounting for this decision making. So I will be sharing my screen right now that we have prepared for accounting for decision making. So as you can see here, I will be explaining on my part in table of contents, which is that we have introduction on page 1, assignment 1 on page 2, assignment 2 on page 5, comparing financial ratios is on the page 8, and conclusion is on the page 10. So let's get straight into the part of introduction. I will be explaining of my part in what is our objective on this assignment. It is to conduct a throughout financial performance between analysis company Nasdaq and company Zara RS. Our main goals in this assignment is to get into insight of the financial health of both companies and identify financial difference between the two companies, which is company Nasdaq and company Zara's. Our main focus is evaluating three key financial ratios, which is liquidity ratios, profitability ratios, and solvency ratios. And our final outcome is to justify which company has a better potential for future investment, either the Nasdaq company or Zara's company, and include that we want to assess potential in managing risk and maximizing returns between two companies, which is a better of choosing Nasdaq company or between choosing a Zara's company.
Assalamualaikum and hi, and I'll be presenting assignment 1, the financial ratios of NASA company. Okay, so as you can see here, on the left we have comparative statements of comprehensive income of the company, and on the right we have the comparative statements of financial position. Okay, here are the financial ratios of the company. Okay, so firstly, current ratio. Okay, so the formula for current ratio is current assets divide current liabilities. Okay, so current assets is 514,000 and current liabilities is 265,000. Okay, the current assets you can get it from here. Here, 514,000, and the current liabilities you can get it from here on the financial position statement. 265,000 here. Okay, and the answer is 1.94 ratio to 1. Okay, next is asset test ratio. Okay, for this one, the formula is cash plus short-term investments plus accounts receivable over current liabilities. Okay, here cash is 79,000, short-term investments is 65,000, and accounts receivable is 120,000, and current liabilities is 265,000. Okay, for the cash, short-term investments, and accounts receivable, you can get it from here on the right here. You can get it from current assets here. Cash is 79,000, short-term investments 65,000, and accounts receivable 120,000. And current liabilities, again, you can get it from here, 265,000. And the answer is 0.996 ratio to 1. Okay, the third one is receivable turnover. Okay, for this one, the formula is net credit sales over average net accounts receivable. Okay, net credit sales is 2.486 million, and the average net accounts receivable is 120,000 plus 100,000. The beginning and ending accounts receivable, you add them up and then you divide by 2. And here the accounts receivable, you can get it from here, current assets, 120,000 plus 100,000. You divide by 2 and then the answer is 22.6 times for receivable turnover. Okay, next is inventory turnover. Okay, inventory turnover, the formula is COGS, cost of goods sold, divided by average inventory. Okay, COGS, you can get it from the comprehensive income statement. Here, 1.523 million. And the average inventory, you can get it from current assets. You just add the beginning and ending inventory, and then you divide by 2, and then you get the average inventory. So 1.523 million divided by 250,500, you'll get 5.915 times for inventory turnover. Okay, so next is profit margin. Profit margin, the formula is net income over net sales. Okay, net income is 94,000 over net sales 2.486 million. Okay, net income, you can get it from here, the comprehensive income, the 2023 one, net income over net sales 2.486 million here. And yeah, and then you will get 0.038, and then you times with 100 to get it in percentage. So the answer is 3.8%. Okay, number 6 is total asset turnover. Okay, the formula for this one is net sales over average total assets. Okay, net sales, again, you can get it from here. And average total assets, you just here. Average total assets, you just plus the two total assets, the 2 years, beginning and ending. You just plus these two, and then you divide them by 2. And then you'll get the average total assets, which is 1.681 million. Okay, so 2.486 million divided by 1.681 million, you'll get 1.48 times. Okay, next one is return on assets. The formula for return on assets is net income over average total assets. Okay, net income, again, you can get it from here, 94,000, and average total assets, the same one as just now. This one, you just plus these two, and then you divide by 2. 1.684 million plus 1.678 million, and then you divide by 2, and then you'll get 1.681 million. And then when you get the answer, you times it with 100 to get it in percentage, and the answer will be 5.59%. Okay, last one is return on common stockholders' equity. The formula is net income over average common stockholders' equity. Okay, so net income, again, 94,000 here, and the average stockholders' equity, to get the average one, you just plus the beginning and ending again. Okay, so for this one, you can get it from here. Okay, stockholders' equity, total stockholders' equity. Okay, for 2022 is 966,000. For 2023 is 1.019 million. You add these two, you add up these two, and then you divide by 2, and then you get the answer. And then when you get the answer, you times it with 100 to get it in percent. So 94,000 divide the average common stockholders' equity, and then you'll get 9.47%. And that is all for assignment 1. Thank you.
Hello, my name is Julia, and I will examine the financial ratios of Zara's company. These ratios provide insights into the company's financial health and performances. First, we're going to do liquidity ratios. Zara's current ratio is 2.5. This indicates that for every ringgit of liability, Zara's has 2.50 ringgits in assets. A higher current ratio suggests that the company is well positioned to cover its short-term liabilities. Zara's quick ratio is 1.8. This excludes inventory from current assets, providing a more strength measure of liquidity. A quick ratio above 1 indicates that Zara's can meet its short-term obligations without relying on the sale of inventory. Second, we're going to explain profitability ratios. Zara's profit margin is 15%. This means that Zara's retains 0.15 ringgit as profit for every dollar of revenue. A higher profit margin indicates efficient cost management and strong profitability. Zorazi's ROA is 10%. This ratio shows how efficiently the company uses assets to generate profit. An ROA of 10% means Zorazi generates 0.10 ringgit for every ringgit of assets. Zorazi's ROE is 20%. This indicates that the company generates a 0.20 cent profit for every ringgit of shareholders' equity. A higher ROE reflects effective management and profitability use of equity financing. 3. We're going to explain solvency ratios. Debt to equity ratios. Zorazi's debt to equity ratio is 0.5. This means that the company has 0.50 cent of debt for every dollar of equity. A lower ratio suggests a more conservative approach to leveraging. And Zorazi's TIE ratio is 6. This ratio means the company's ability to meet its debt obligation depends on its current income. A TIE ratio of 6 indicates that Zorazi's earns 6 times its interest obligations, showcasing strong debt management and lower financial risk. These ratios highlight Zorazi's financial strength and areas for potential improvement, providing a comprehensive view of the company's financial performances.
Moving on, we will compare the financial ratios of company Naza and company Zararis. There will be 3 important ratios that we will be comparing, which is liquidity ratio, solvency ratio, and profitability ratio. Let's start with the liquidity ratio first. From the slide, we get to determine the current ratio for Naza and Zararis company. It seems like Naza has a better short-term financial stability because of the current ratio is 1.94, which is higher than Zararis company 1.48. Naza company also has a better immediate liquidity because the asset test ratio is also higher than Zararis, which is 0.996. For their receivable turnover, once again, Naza show us a significant result with 22.6 times efficiency rather than Zararis, which is 7.5 times. Lastly, Naza also has more efficient inventory turnover rather than Zararis company. From the liquidity ratio, Naza outperforms Zararis company in all liquidity metrics, indicating it is more capable of making short-term obligation and managing its working capital efficiently. Next is to compare the solvency ratio between Naza company and Zararis company. For their debt to asset ratio, Naza has slightly less financial risk with lower reliance on debt, which is 39.49% compared to Zararis company 41.54%. Furthermore, from the time interest earned, Zararis is more capable of covering its interest expenses. From the solvency ratio, we can see that Zararis sustainability higher time interest earned ratio show its strong debt obligation effectively, while Naza maintain a marginal lower debt to asset ratio, indicating less leverage and financial risk. Lastly, we're going to calculate the profitability ratio for both companies. For the profit margin, Zararis shows a higher profit margin with 6.4% profit margin compared to Naza company 3.8%, which means Zararis has a better cost control and higher profitability. However, Naza generates more sales per dollar of asset compared to Zararis with 1.48 times for Naza and 1.001 times for Zararis. For their return on asset, Zararis show more efficiency in converting asset into net income because return on asset for Zararis is 6.4% while Naza have 5.59%. For return on equity, Zararis also provide a better return on equity for its investor because Zararis has 10.62% compared to Naza 9.47%. For summary, company Zararis demonstrate superior profitability across key metrics, profit margin, return on asset, and return on equity, indicating it's more effective in generating profit and delivering returns to shareholders. For conclusion, the company we choose is Zararis company. We choose this company based on these four important factors, which is profitability, solvency, long-term prospect, and shareholder wealth maximization. For profitability, Zararis show higher profit margin, return on asset, return on equity that indicates stronger profit generating ability. For solvency, despite higher leverage, Zararis better time interest earn ratio shows strong debt management and lower financial risk. Thirdly is long-term prospect. Zararis company offers better long-term profitability and financial stability. And lastly is shareholder wealth maximization. We choose Zararis company because their financial metrics align with the goal of maximizing shareholders' wealth. That's all from us. Thank you very much.